Good morning, everybody. Like we've got another couple of minutes before we start here, but hang tight so we can get to 10 o'clock. All right. Good morning, everybody. Thanks for joining the webinar here on buy downs, and a lot of talk about the buy downs and how they work and so forth. And so today what we'll do is we'll go through kind of what a buy down is and how you can use that to help you as a buyer to lower your interest rate, or as an agent to actually help your buyers get into a property at the lower payments for the first couple years of the loan. So let's go through this here. And if you have any questions, go ahead and make sure that you put them in the chat, and we'll try and get those questions answered. There'll be some Q&As at the end of the presentation here. So as interest rates have been kind of going up here, you know, it's been getting tougher and tougher for buyers to buy houses with the increased interest rates. And so what we want to do is utilize these buy downs to help them, at least for the first couple of years, while they're starting out their payments on their houses. And then, you know, if the rates do come down after the first of the year, which we think they will, then we can refinance them into a lower rate mortgage. But let's go through these here and give you an idea of how this actually works here. So a buy down, like I've been saying, is basically it allows the borrower to reduce their rate for the first few years of the loan. So it's going to be, well, I'll go into some of the details in just a second here, but basically it gives them that lower payment for the first couple years of the loan. So there's a couple of different temporary buy downs that we have. There's a limited buy down, which is a 2-1 buy down, and that 2-1 buy down is lowering the interest rate 2% the first year, 1% lower the second year, and then goes up to the actual note rate for the third through the final year of that term of that particular loan. The extended buy down is the same thing. It's very similar, except it goes down 3% the first year, 2% the second year, and then 1% below the note rate the third year, and then the fourth through the final year of the term, it goes up to the actual note rate. So that's the kind of the definition. You can only go down, the maximum that you can go down is the 3%, and then every year the maximum that it can go up is actually only 1% per year. So you can't go more than 1% because they don't want it to be a stress on the homeowner for their mortgage payment going up that by that amount. So those are the two kind of temporary buy downs that we're going to be talking about today. And let me give you just a quick example. This is Freddie Mac, and I'm sorry, this is a Fannie Freddie loan, and this is a $300,000 loan. So this is kind of an example that Freddie Mac has given to us. And what you can see is up at the top is year 1, 2, 3, 4, and 5. And the first example is a 30-year fixed rate mortgage at 6%. So this is a little bit dated as far as the interest rates. They're a little bit higher than this right now. But on a regular 30-year fixed rate mortgage, $300,000 loan, your principal and interest payment would be $1,799 for the first year, second year, third, all the way through the term of the loan. And there would be no cost for that particular rate because you're not doing a buy down. Now, let's skip down to the 2-1 buy down, which is the third row down. And basically what we do is you're going to compare that to the top row. And the 2-1 buy down, the rate is 2% lower during the first year. So your payment goes down to $1,432 from the $1,799. The second year, it goes down the 1% to the $1,610, so $1,610 from the $1,799. And then the third through the final year of that loan, it goes to $1,799. And I'll go over the upfront costs with you in just a second here. But that's an example of the 2-1 buy down on a $300,000 loan. Now, the 3-2-1 buy down is the exact same. It's just you get one more year of the reduced payments. And so it's $1,265 for the first year versus the $1,799. The second year, $1,432 versus the $1,799. And then the third year is $1,610 versus the $1,799. And then after that, it goes up to the regular note rate of $1,799. So that's the reduced payment that you see for that particular buyer or the mortgagee on that particular loan. So it gives them that kickstart of a lower payment for the first couple years of the loan. Now, the cost for these, and it changes based on the loan amount and your interest rate and your payments, right? And so on this particular loan, the 2-1 buy down, the way that we calculate the cost that the seller actually has to pay on this. So the buyer cannot pay for this. The seller has to pay this. And basically what it is, it's the difference between the $1,799 and the $1,432 on the 2-1 buy down example, and for 12 months. So you take that difference, you multiply it times 12. Oops, sorry about that. And then you get $4,404. You do that for the second year. So the difference between $1,799 and $610, you multiply that times 12 for the full year, and you get $2,268. So the total cost for this buy down is $6,672 that the seller is going to have to contribute towards that buy down. Now, it's the same thing for the 3-2-1 buy down. I'm not going to go through the numbers with you on this, but it gets more expensive because it's 3 years of those lower payments that you have to multiply out. So you have to, instead of 2 years, you have to do 3 years, and it's $13,080 on this particular example on a $300,000 loan. So I'm going to give you kind of, since we're in California, where we do most of our loans here, I'm going to give you a little bit kind of a better example with current interest rates. And they've been coming down a little bit here over the last couple of days. And so this is a little dated, but this one is what we call a 3-2-1 buy down. So this is the extended version here. And basically this is a $730,000 purchase price, 20% down on a $600,000 loan, and your interest rate at 7.625. So your payment would be $4,246 on this particular loan without a buy down. If you did do the buy down, which is the 3-2-1 buy down, year one, it would be 4.625. So your payment would be $3,084, or about $1,161 lower than the actual note rate on this particular transaction. The second year, it would go to 5.625, and your payment would go to $34.53.94, which is about $792 less than the actual note rate. And then in the third year, it would go to 6.625%, and your payment would go up to $3,841. So you can see this is a great start for a buyer to get into a property and actually have some money left over each month to use that for upgrades, or just to, just to get in the flow of making their mortgage payments. So what does this particular loan cost? So we do the same thing. We multiply those differences in the payments, multiply them times 12 for each year. And in this instance, on this particular loan, it's going to cost $28,315.75 for the seller to contribute those funds to an escrow account to help kind of subsidize the payment for the first 3 years on this particular transaction. So we'll go into a couple of the details a little bit later as to why that might be better or worse for the buyer or the seller, but that gives you an idea on a 3-2-1 buy down. Another example is the same purchase price, same loan amount. We just do the 2-1 buy down. And on that 2-1 buy down, it's only going to cost you about $14,372. I say only because that's a lot different than the 3-2-1 buy down, which is double that amount. But it gives the borrower, again, 2 years of reduced payments at $792 for the first 12 months, and then $404 for the additional year after that, and then back up to the note rate on the final year. So this one is going to cost the seller $14,372. So what is the purchase contract going to look like in this particular transaction? So for the agents that are out there, this is a California contract. So I don't have any examples for some of the other states, but this is where we would put it in the California contract. And keep in mind that the buy down cost has to be paid by the seller. The borrower cannot pay for the buy down on this. So in section G1, you're going to have the credits, okay? And it says seller credits, if any, to the buyer. And you're going to check this box here, and you're going to put in a dollar amount. That's why it's super important that you work with a loan officer on these transactions to know what the actual cost of these buy downs are going to be. So you have to get a really good idea of what that cost is going to be, put in the dollar amount. And then on the additional terms, you need to put for a temporary buy down. So you have to make sure that that is in the contract, that it says for a temporary buy down. And that will give you, the seller the information that they're going to give that credit to the buyer of their property. So that's how it's going to look in the contract. The buyer, seller, and lender are going to actually have to have a buy down agreement. So what I'm going to tell you is everything on the loan is the same. So when we draw our loan documents up, the note is going to have the actual note rate payment. So in the examples that we had at 7.625, the borrower is going to sign that note that says that their payment is going to be based on that 7.625 interest rate. What they have to do is actually sign a buy down agreement that is separate from the note. And in that agreement, it basically tells you what your loan amount is going to be, what the actual interest rate is. And then down here, they're going to have a buy down schedule, and it's going to show you those buy downs like each year: 4.625, 5.625, 6.625, and what that buy down amount is, and what the total interest, principal and interest payment is going to be. So in the example that we had before, it was the 321. We had $28,000 in change in there for the buy down fund. This is exactly what this agreement is going to show you on this transaction. And so the seller is going to take that $28,000, credit it to the buyer. And as the lender, we're going to put it into an escrow account. And each month, in fact, I'll show you this, and each month we're going to subsidize that payment. So this is what the borrower is going to pay year one every month for 12 months is $3,453.94. Their total payment is $4,246. So they're short by $792 in this particular example. So what we do is we go to the escrow account. There's $14,000 in it. We take $792.82 out of there, and we actually make their payment whole. So each month, the borrower is going to amortize this loan over 30 years. And all we're doing is taking the escrow money out of the escrow account and actually subsidizing the payment that the borrower is making to make the full payment on that particular transaction. So even though the borrower is making a payment of $3,453.94, we're taking money out of the escrow account to make that full payment for the first, in this example, first 2 years of the loan. But that makes your payment whole. It makes the amortization of 30 years correct. And so you're going to actually make that payment for 30 years. It's just subsidized by that escrow account that we put money into from the seller concessions at the end of the transaction. A couple of guideline things that I would want to go over. One is that we actually qualify on the buy downs. We qualify them at the note rate. So in the example that we went over, it was 7.625. They have to make sure that they qualify at that payment, because in 2 or 3 years, that's the payment that they're going to have to make as a borrower. And we have to make sure that they can qualify for that. We talked about the 3%, the rate reductions. We can't go more than 3% down on the note rate. So if it was a 6% note rate, we could go down to a maximum of 3%. If it was a 5% note rate, we could go down to 2%. So even if the interest rates do come down over time, we can actually give you a lower rate, and it is helpful to the buyers at that point in time as well. So it's just a lower interest rate market. We can give those reductions. The maximum annual increases are 1% per year. So if we started out at the 6% was the note rate, and we went down to the 3% for the 321, the maximum second year rate can be 4%. The maximum third year rate can be 5%, and then it would go to 6% after that. So maximum of 1% per year. A couple of questions always come in about what happens if I pay the loan off during that buy down period. So this is a good question at this point in time, because we think that interest rates are actually going to go down during the first half of this next year. So if you close one of these loans right now today, and you refinance it in 6 months to a regular 30-year fixed rate mortgage, then all of that excess funds that are in your escrow account that the seller paid for are going to go to a principal reduction. So if you owed $600,000 on that loan and you had another $10,000 left in your escrow account from the buy down, we would use that. We would refinance you at $590,000 versus the $600,000. So as a borrower, this actually helps you within the first 2 or 3 years of the loan to actually get your principal reduction if you pay it off over in that time frame. Some people have asked the questions as to kind of why not just reduce the purchase price and not do the 2-1 or the 3-2-1 buy down. And that's always just a negotiation or a strategy on what would help you as you're trying to purchase this house as a buyer or the real estate agent. And so it just really depends on what is going to be the best benefit for you. If you're only going to reduce the purchase price by $10,000 or $15,000, then it might not be a strong enough offer for you to get that property. You might want to go in at the higher purchase price and ask for those buy down funds to get the lower interest rate for the first couple of years. And this is some of the strategies. Listing agents. If you are not talking to your sellers at this point in time about buy downs or permanent buy downs or temporary buy downs, you need to be doing that, because these are a lot of the offers are coming in that I'm seeing right now, having the seller give these buy down concessions to get the lower interest rates. And so you need to prepare your sellers to kind of get in that frame of mind as to what your list price is going to be and how much you're going to give for that seller concession. And so the other strategy on that is, what is your drop in sales price going to be versus the contribution to helping buying down that interest rate? So like we talked about the $28,000 on the 3-2-1 buy down. If you're going to drop your price by more than $30,000, then it might be beneficial to you to keep that price up and offer those buy downs on the transaction. So it just really depends on where you want to be as far as negotiations and price wise with your sellers. On the buying side for the agents, it's basically a stronger offer versus the lower purchase price. So you can go in, put in a strong offer, but then actually offer these buy downs. And this morning, I just put together a scenario for an agent. Their list price was $760,000. They gave they got an offer for $700,000. And what I prepared for them was basically I switched it around and said, instead of doing a $700,000 purchase price, let's do a $750,000 purchase price, give a $12,000 concession to lower the interest rate, and the payment would be the same as if it was at the $700,000 purchase price. So there's just different ways of negotiating and getting in a stronger offer for those buying agents and actually having the same or lower payment for your buyers. So you definitely need to use this as a negotiating tool for your buyers, and talking them through this throughout the whole process, and for the loan officers to give you those strategies. And I can line those up side by side to give you an idea of what those would look like, so that they can have a better idea of how they're going into purchase these houses with the buy downs. Pros and cons. First couple of years of lower payments for the buyers. So we talked about that. And the borrower gets the buy down monies if they refinance or sell the property within that buy down period. So that's a nice option, especially if that escrow account or that contribution from the seller is a pretty big contribution, and the interest rates do go down here in the next 6 to 9 months. The cons on this is basically that they're qualifying at the note rate versus some of the permanent buy downs, you'll qualify at the lower interest rate. So if it's a qualifying issue and as a buyer, you can't qualify for the higher note rate, then a permanent buy down might be an option to where we can get you qualified at a permanent buy down rate. And we're not going over the permanent buy downs right now, but basically that gives you for the life of the loan, a lower interest rate. And then the cons for the seller is basically that they're giving concessions on their sale, but that might get the property sold for them as well. So rather than either not selling it at all or actually having to get a lower purchase price, like I talked about on that $700,000 transaction versus the $760 or $750 purchase price. So that is all that I have for kind of this presentation. Does anybody have any questions that I can go through? Let me see if I can get to my notes here, or if you want to unmute, I don't know, can you unmute yourself? Okay, if you have a question, I would love to answer them. So just go ahead and unmute yourself and ask a question.
Mike, just an easy question. You're going to make this available via email, the presentation?
Yes, so I'm going to put it on YouTube. It'll be up by tomorrow. If you on my screen, there's the my YouTube is Mortgage Wise, and so it'll be up on YouTube by tomorrow afternoon.
Perfect.
Awesome. That was let's see here. Let me see if I can go to the chat. Really, thank you. All right. Yes.
Is there any reason someone couldn't get a buy down, or can everyone get it? Like, is there anything that would disqualify someone from it?
No, the only thing that it would be if they can't qualify at that note rate. But yeah, anybody can get the buy down as long as the seller is paying for the buy down costs. Good question. All right. Appreciate the time, guys. Have a great week. And if you have any other questions, feel free to text me or shoot me an email. I'd love to answer them. Have a great day.
Thanks, Mike.
Bye-bye.